After a turbulent 2024, will S-REITs recover this year? And are there opportunities for investors?
Since 2009, there has been no consecutive decline in REIT share prices for 2 years. That means that every negative year is followed by a positive year for REIT performance this year. We do not expect share prices to decline since they've fallen 12%. But whether or not they will climb and rebound is really anyone's guess.
Higher interest rates over the last 3 years have weighed on S-REITs. That's because REITs take on debt to grow their portfolio, so higher rates mean higher financing cost. This also eats into the distribution per unit, or DPU, meaning investors receive a smaller payout per unit of a real estate investment trust, or REIT. These have traditionally been popular with investors because of their relatively low entry costs and reliable dividends.
I think we expect DPU to grow as a sector in the low single digits, maybe about 1 to 2% for 2025. A few reasons for this. The first is that interest costs are likely to decline from here for some of the REITs. Secondly, we are seeing pretty positive rental reversions for a number of REITs. So lower interest costs plus better rental outlook also means that distributable income should increase.
In September 2024, when the US Federal Reserve, or Fed, finally started to cut interest rates, there was optimism that lower borrowing costs will help S-REITs stage a recovery. But now, the Fed seems to be in little hurry to trim rates further, weighing on shares of S-REITs. Higher for longer interest rates will mean more pain for REITs in the short term.
Interest rate expectations have stabilized quite a lot. They are not going to be increasing, but neither are they going to be decreasing as much as expected. And the MAS has eased policy for the first time since 2020. And I think with lower inflation, you also have some scope for interest rates in Singapore to come down, which should benefit the S-REITs. And if we go into a lower growth situation, should there be a severe downturn for any reason, I think that investors would probably look to the safety of REITs, and there could be a flight to safety in such an incident.
The market pullback has resulted in some attractive valuations. S-REITs are at a price-to-book ratio of around 0.85, below the 5-year average of 0.99. The estimated dividend yield of 6.5% is also above the 5-year average of 6%.
For 2025, we definitely like the new economy sectors. By new economy, I'm referring to things like data centers, logistics, high-tech business parks. These new economy stories are underpinned by a structural growth trend.
Data center is another sector which has also benefited a lot from the latest developments of AI, etc. So I would say some of the big names we like in the sector include Capital and Ascendas REIT, AIMS APAC REIT are some of the names which are preferred in this sector.
In January, the Chinese app DeepSeek sparked concerns that cheaper AI development costs could hit demand for data centers. S-REITs with exposures to data centers like Keppel DC REIT took a hit.
I would say that the sell-off really is something that is not justified. Keppel DC REIT, to be fair, is not a cheap REIT. It trades at pretty pricey valuations of maybe 4-ish% yield. But this is justified by its growth prospects, and the Singapore data center market, structurally, its supply is just not there.
However, in the long run, analysts say that this could be positive for REITs.
I think DeepSeek was a shock. It kind of came out of the blue, and it really dealt a blow to the American idea of their supremacy in the data center AI space. Having said that, we are quite positive actually. We might see lower cost of using AI.
Mapletree Industrial Trust is yielding roughly about 6.7%. This was right after the announcement of DeepSeek. So what's interesting is that Mapletree Industrial Trust, their data centers focuses a lot on locking in tenants. Many of their data centers are located in the US, in very prime locations. The only problem is the share price have actually dropped But if you look at where the trajectory of data centers are going, it's actually a very big market, and there's still an underserved market for data centers.
Market watchers are also positive on retail for 2025.
We are starting to see a reopening of the economy. So traffic is coming back to many of the retail malls, not just in the Orchard Road belt, but also in the heartland areas. You can see, for instance, CapitaLand Integrated Commercial Trust, they have been very stable with their DPU, with their distribution per unit. In fact, their retail malls have seen a meaningful increase in their rental adjustments. Fraser Centrepoint Trust is another Singapore REIT which I use. So today it's actually trading at about closer to 6% dividend yield for a blue chip REIT which owns very high quality retail malls.
On the flip side, analysts are cautious about the hospitality sector.
I think hospitality is something that we are perhaps seeing a few headwinds. Revenue per available room in Singapore, for example, is flattening out for a number of our hospitality landlords. Costs are also rising, so this is something that we would see as a less promising sector in the near term.
The supply has increased by about 5% in the hospitality space over the last 18 months, and that means higher competition. Even if you look at 2025, we don't have some of the major events which we had in last year. So with the absence of tailwinds and supply catching up, we believe this would be a year of stabilization for hospitality REITs.
You may also want to approach S-REITs that have overseas exposure with caution.
Singapore dollar, it has actually gained strength over the last couple of years versus overseas currency, which means that investing in these properties, even though you could see an increase in rental income, the big problem is that upon currency exchange, that could actually see a decline in your distribution which you have actually received. If you look at Singapore REITs which invest overseas, some of the sectors might not have recovered from the COVID-19 pandemic. One instance is US offices, where their occupancy rate has generally been depressed because there is a paradigm shift for people who want to do a hybrid working arrangement.
In Singapore, slower growth in the office sector could present a buying opportunity.
We are seeing that back to office trend picking up, CBD office demand picking up in the market. Besides that, supply, if you look at CBD supply over the next 3 to 5 years, the supply is actually quite muted. Office, especially Singapore office, is a sector which I think can do well, and it is undervalued at this point of time. We believe Keppel REIT is trading at a deep discount to valuations. CapitaLand Integrated Commercial Trust is another topic we like.
So office is something that we are pretty neutral on, but I think rents are already at a multi-year high, and if we see economic headwinds coming along in the form of trade wars and perhaps a slowing of economic activity, the office rents tend to be quite correlated with economic growth, so we could see a bit of softening there.